In 2025, the smoke cleared, but the contracts didn't return. The news helicopters had long since departed the Los Angeles skyline. The ember storms that swept through the Palisades and the canyons in January were gone. The heat had dissipated, but the silence that followed was heavier than the ash. It was a different kind of suffocation. Residents returned to standing homes, wiped the soot from their mailboxes, and opened the little white envelopes waiting inside. They weren't bills. They were eviction notices from reality. Notice of non-renewal. You see, we focus so much on the fire, the physical destruction, the $37 billion in tangible structure damage reported in the first quarter of 2025. That number is tragic, but it is manageable. The system can digest $37 billion. What the system cannot digest is the lie underneath it. There is a glitch in the matrix of American wealth, a glitch so massive that when the McKinsey Global Institute finally quantified it in their 2025 report, the banking sector didn't panic. They went catatonic. McKinsey calls it the protection gap. I call it the $2 trillion lie. Here is the reality they are terrified to tell you. In California alone, the gap between the property values listed on bank balance sheets and the actual available insurance protection for those assets is now between $1.35 and $2 trillion. Let that sink in. $2 trillion. That is not a margin of error. That is the GDP of Brazil simply missing, vaporized. For decades, we operated under a simple assumption. You buy a house, you pay the premium. If the house burns down, the company writes a check. The house is an asset because it is protected. But late last year, the math broke. State Farm, Allstate, the giants of the industry, they didn't just pause new applications. They looked at the actuarial tables for 2025 and 2026, saw the heat maps, saw the regulatory caps, and they engaged in a capital strike. They fled. So, what happens when the insurer leaves? You turn to the state, the insurer of last resort, the California Fair Plan. It sounds noble, doesn't it? Fair, balanced, safety net. But look at the numbers released in December 2025. The Fair Plan is currently holding $724 billion in liability exposure. $724 billion. That is a 37% increase year over year. In the fourth quarter alone, they added $28 billion of risk. Here is the problem. The Fair Plan isn't an insurance company. It's a pool, a bucket. It doesn't have $700 billion. It has a fraction of that in reserves. It is a solvent entity only as long as the sky doesn't turn orange again. If a major event hits a true catastrophe, that plan is not a safety net. It is a suicide pact for the state budget. And the banks know this. This is where the story shifts from environmental disaster to economic collapse. Think about your mortgage. It is a contract. That contract requires you to maintain hazardous insurance coverage. If you cannot get private insurance because State Farm left, and you cannot afford the Fair Plan because the premiums just tripled, you are in technical default. The bank then engages in something called force-placed insurance. They buy a policy for you. It covers them, not you. It costs 4, 5, maybe 10 times what you were paying. Suddenly, your monthly payment jumps from $4,000 to $9,000. You can't pay it. You try to sell. But who buys a $2 million home that cannot be insured? No one. And this is the mechanics of the crash. It's not a bubble popping. It's a foundation dissolving. First Street Foundation data shows that the moment a property receives a non-renewal letter, its market value effectively drops by 12% overnight, but that's generous. That's optimistic. In the luxury fire zones of California, the value drop isn't 12%. It is 100%. Because an uninsurable asset is not an asset. It is a liability. It is just a pile of wood and drywall waiting to bankrupt you. The $2 trillion lie is the fact that these homes are still sitting on the books of Wells Fargo, of Chase, of Bank of America, valued at their 2024 peak pricing. The collateral for the securities is marked as prime. It is phantom equity. The homeowners are walking dead, financially speaking. They just don't know it yet because the foreclosure hasn't hit the county clerk's desk. We are witnessing the death of the 30-year mortgage in the American West. The liquidity cycle is dead. When you drive through these neighborhoods now, past the areas where the fires actually burned, you see something terrifying. You see for sale signs, but they are yellowing. They have been there for months. You see perfectly manicured lawns. You see fresh paint, but inside the kitchen, there is a family sitting in silence, staring at a renewal offer from the FAIR plan that asks for $30,000 a year for a policy that doesn't even cover water damage. They are realizing that their net worth was a hallucination. The insurance industry was the canary in the coal mine. They deal in real risk. They don't care about political posturing or optimistic projections. They care about math. And the math says the land is hostile. The insurers have evacuated. They have taken the lifeboats. And the rest of us? The millions of homeowners, the pension funds invested in mortgage-backed securities, the local governments relying on property taxes, we are left on the ship. And the ship is made of paper. This isn't just about California. This is the new contagion. Florida is already gone, hidden behind state-run insolvencies. Texas is buckling under hail and wind claims. But the California gap, the sheer size of that $2 trillion hole, that is the thing that breaks the global ledger. Because when those asset write-downs finally happen, and they will happen, probably next quarter when the regulators force the mark-to-market accounting capital will freeze. It will be 2008, but without the ability to bail it out. You can print money to fill a liquidity hole. You cannot print money to unburn a forest. You cannot print money to make a geyser of liability disappear. The contracts are gone, and as the protection evaporates, something else begins to erode. Something much older. The currency itself, because what backs the dollar? Faith. Faith in the assets of the United States. Faith that if you lend money to an American for a home, you will get paid back. But if the home is uninsurable, the loan is void. The asset is zero. The faith is broken. We aren't just looking at a housing crisis. We are staring into a void where the middle class used to store its wealth. The smoke from the January fires has cleared. You can breathe the air again, but take a deep breath. Can you smell it? It's not wood smoke. It's the smell of rotting paper. It's the scent of a promise that has been broken. And as the insurance adjusters retreat, they leave behind dry ground, perfectly prepped for the next phase of the collapse. Because money is just dust. And the wind is picking up. We call this a climate crisis. Our grandfathers called it the Dust Bowl. The physics are different, but the financial wreckage is identical. History has a cruel habit of rhyming, but usually we are too deafened by the noise of the ticker tape to hear the cadence. To understand why your property value is about to evaporate, we have to look back at the last time the sky turned black and the banks locked their doors. The 1920s, the Great Plow-Up. It wasn't just a farming boom. It was a credit bubble, a hallucination fueled by cheap loans and a few years of unusually heavy rain. The bankers in Chicago and New York looked at the semi-arid plains of Kansas and Oklahoma, and they didn't see dry dirt. They seen a balance sheet. They saw collateral. Millions of acres of ancient grassland. The skin of the earth that had held the soil together for 10,000 years was ripped open, 5.2 million acres. Tractors, bought on credit, tore through the sod. The wheat prices were high. Everyone was going to be rich. The local bank manager wasn't just a lender, he was a cheerleader. He was handing out mortgages based on the premise that the rain would never stop, that the geography itself had changed to accommodate the economy. Does that sound familiar? It should, because right now, you are sitting in a house or an apartment or an office that is valued based on a similar lie. The lie that the climate is stable, the lie that the risk is calculable. In the 1920s, the hallucination lasted for a decade. Then the rain stopped. The 14th of April, 1935, Black Sunday. Witnesses didn't describe it as a storm. They described it as a solid wall, a mountain of black earth, thousands of feet high, rolling across the plains at 60 miles an hour. It blotted out the sun. It turned noon into midnight. Birds fell dead from the sky, their lungs packed with silica. But the most terrifying destruction wasn't biological. It was financial. When the dust cleared, the bankers went out to inspect the collateral for their loans. They went to foreclose on the farms. They drove out to the coordinates written on the deed, and they found nothing. I don't mean the house was gone. I mean the land was gone. The topsoil, the actual asset that gave the farm its value, had been lifted into the stratosphere and deposited in the Atlantic Ocean. The farm wasn't there anymore. It was just a hole in the ground. The banks collapsed, not because they ran out of cash, but because the assets backing their paper simply blew away. The mortgage contract remained, but the reality beneath it had vanished. Fast forward 90 years, the dust has settled, but the blindness remains. We are currently living through the second great plowup, except this time, we aren't plowing grass. We are paving over floodplains. We are building subdivisions and fire corridors. We are erecting glass towers on coastlines that are actively sinking, and just like the 1920s, the entire system is held up by a financial promise that is physically impossible to keep. Enter the blue line. This is the new term keeping insurance executives awake at night. You know about redlining, the racist practice of denying services to specific neighborhoods. Blue lining is colder. It is purely mathematical. It is the practice of drawing a line on a map where the financial system simply ceases to exist. Inside the line, you are part of the modern economy. You can get a mortgage. You can sell your home. You have value. Outside the line, you are in the wilderness, and the line is moving. In 2025, we saw the data drop. It was quiet, buried in industry reports, but it was the modern equivalent of Black Sunday. California's insurer of last resort, the FAIR Plan, swelled to cover 669,000 properties. Let me contextualize that number for you. That is nearly 700,000 families who have been rejected by the free market. The private insurers, the companies whose entire business model is based on calculating risk, took one look at those homes and said, no. They didn't raise the price. They didn't adjust the deductible. They left. The liability held by the state of California in this last resort pool is now larger than the exposure in Florida and Texas combined. Think about the weight of that. The fifth largest economy in the world is effectively backstopping a housing market that the experts have deemed uninsurable. This is the invisible dust storm. You can't see it darkening the sky yet. The sun is still shining in the Palisades. The palm trees are still swaying in Miami, but the financial atmosphere has already turned toxic. When an insurer executes a market withdrawal, fancy corporate speak for abandonment, they are doing exactly what the wind did in 1935. They are stripping away the topsoil. Because without insurance, a mortgage is technically in default. Without insurance, a buyer cannot get a loan. Without a buyer, the asset acts like it has value. But if you tried to sell it, you would find only silence. The price of your home on Zillow is the 1,929 week price. It's a ghost number. It assumes a liquidity that is no longer there. We saw this in Florida, too. Major carriers pulling out, leaving the state-run Citizens Insurance to hold the bag. They call it depopulation of the risk pool. But what it really means is the depopulation of your net worth. The banks know this. Why do you think the requirements for down payments are shifting? Why do you think the scrutiny on flood maps is intensifying? They are trying to offload the risk onto you before the wind picks up speed. In 1935, the farmers stood on their porches and watched the soil strip the paint off their cars. They watched their livelihood dissolve into granular, rushing darkness. They couldn't stop it. The physics were overwhelming. Today, You are watching the insurance premiums double, triple, and then vanish altogether. You open the envelope, and it's a non-renewal notice. That piece of paper is the first gust of wind. It is the signal that you have been blue-lined. You are now standing on the wrong side of the wall, and just like the bankers looking at the barren hardpan of Oklahoma, the market is realizing that the collateral is gone. The house is still there, the walls are solid, the roof is intact, but the value, the money, that's just dust. And we are just watching it blow away, helplessly, as the algorithms in New York and London redraw the map of the habitable world without asking for our permission. The terrifying part isn't that the system is crashing. The terrifying part is that the crash already happened. The contracts are void. The insurers have left the building. We are just the last ones to find out. And now, the question isn't how to stop the storm. The question is, where is the lifeboat? And who gets a seat? Some people think the lifeboat is a physical thing. A bunker in New Zealand, a farm in the Ozarks, a yacht with a desalination plant. They are looking for wood and steel, but the lifeboat was never a vehicle. It was a line of code. And by the time you realize you aren't on the passenger manifest, the water will already be touching your ankles. In the 1930s, you could see the enemy. It was a wall of black dust, 5,000 feet high, rolling across the panhandle. You could taste the grit in your teeth. You knew when to run. But the storm we are tracking today is invisible. It doesn't block the sun. It blocks the transaction. Welcome to the era of the blue line. For decades, we talked about redlining. That was the deliberate racist segregation of the 20th century. Banks drawing red ink around neighborhoods they deemed hazardous, effectively choking off capital to minority communities. It was brutal. It was malicious. But it was human. It was a decision made by men in smoke-filled rooms. What is happening now is different. It is colder. It is purely mathematical. Blue lining is the quiet, algorithmic retreat of global capital from the face of the earth. It is not based on who you are. The algorithm does not care about your credit score, your politics, or your family history. It cares about physics. It cares about the heat vibrating off the pavement and the water table rising beneath the foundation. And the horrifying part? You don't know you've been blue-lined until you try to sell. Look at San Francisco. Back in 2023, the headlines were screaming about a doom loop. They called it a temporary post-pandemic correction. They said the workers would return. They said the technology sector was just pivoting. They lied. By the second quarter of 2025, the vacancy rate in San Francisco's central business district didn't just hit a record. It shattered reality. The official numbers from Cushman and Wakefield came in at nearly 34%. But if you walk down Market Street, if you look at the mid-market corridor, the vacancy isn't 30%. It is 50%. Half. Let that number settle in your chest. 1 out of every 2 windows you see is dark. 1 out of every 2 desks is gathering dust. This isn't a recession. A recession is when activity slows down. This is necrosis. The tissue is dying. I want you to imagine the sound of a tower that is 50% empty. The HVAC systems are still humming, programmed to cool bodies that aren't there. The elevators sit idle in the shafts. The security guards patrol lobbies that echo with the sound of their own footsteps. It is a mausoleum of late-stage capitalism. But why? Why aren't the prices dropping enough to fill the space? Why isn't the market correcting? Because the owners can't sell, and the buyers can't buy. The capital has blue-lined the city. The risk models used by the major insurers and the global banks have flagged the entire region as uninsurable. And if you cannot insure the asset, you cannot finance the asset. If you cannot finance it, it has no value. It is just a pile of glass and steel waiting for the inevitable. This is the silent exit. It started with State Farm and Allstate. In 2024, they stopped writing new policies in California. They told us it was about wildfire density and construction costs. But then came the letters. 72,000 cancellations in a single wave. 72,000 families opened their mailboxes and found out their net worth had just evaporated. Think about the psychology of that moment. You are standing in your kitchen, the coffee is brewing, the kids are getting ready for school. You open a letter that looks like a utility bill, and in 3 paragraphs of sterile corporate language, you are told that the shield is gone. You call your broker. They tell you there are no other options. You call the state Fair Plan. They quote you a price that is 4 times your mortgage payment. Suddenly, you are trapped. You can't sell that house. Who would buy a home that enters immediate default the moment the title transfers? You just became a squatter in your own investment. This is the mechanism of the blue line to the south in Florida and the west in California. It is a pincer movement. The insurers are the canaries in the coal mine. They have the best data in the world. They have satellites measuring soil moisture. They have AI models predicting wind shear. When State Farm walks away from a market, they aren't guessing. They are reacting to a mathematical certainty that you cannot see yet. They know that the liquidity cycle is ending. They know that the assets on the books of the regional banks are toxic. And this is where the $2 trillion lie from Chapter 1 comes full circle. The money printed to save the economy didn't fix the foundation, it just painted over the cracks. But water doesn't care about paint. Fire doesn't care about the Fed's balance sheet. The blue line creates a binary world. Inside the line, liquidity flows. Loans are approved. Insurance is affordable. Life looks normal. Outside the line, the desert. And the line is moving. It is constricting. A few years ago, the line was just around the coastal flood zones. Then it moved inland, wrapping around the wildfire corridors. Now, it is encircling entire zip codes where the heat dome lingers too long, straining the power grid to the breaking point. You might think you are safe because you don't live on the beach or in the forest. You live in the suburbs. You live in a boring, stable cul-de-sac. But ask yourself, who holds your mortgage? Is it a local bank that knows your name? Or is it a bundle of securities managed by a fund in New York? Because when the algorithm updates, when that risk map refreshes at 3 a.m. on a server farm in Virginia, your cul-de-sac might turn blue. And you won't hear a siren. You won't see a smoke signal. You will just go to swipe your card or renew your policy or refinance your loan, and the system will simply say, prohibited. The silence of San Francisco's empty towers is coming to a neighborhood near you. It is the silence of capital flight. The silence of a system that has decided you are no longer a viable bet. We are watching the greatest repricing of assets in human history. And it is not happening on the stock market ticker. It is happening in the hidden databases of the insurance giants. They are building the lifeboat. They have been building it for years. They are deciding which assets get to float and which ones are cut loose. And if you have to ask whether you have a seat, you already know the answer. The line has been drawn, the ink is dry, and you are on the wrong side of it. But being on the wrong side of the line isn't just about digital access. It isn't just about a frozen bank account or a declined credit card. That is simply the mechanism of control. The real horror, the true realization that wakes you up at 3 a.m. is understanding what that line was actually protecting. It was protecting the exit. While you were told to look at the burning real estate market, while you were distracted by the ember storms in the Palisades, the smart money wasn't looking at the land. They knew the land was dead. They knew that if the American dollar is debt-backed by real estate, and that real estate is uninsurable, then the dollar itself is just a ghost story we tell ourselves to keep the lights on. So where do you run when the currency is a ghost? You don't run to crypto, you don't run to stocks, you run to the only thing that doesn't require a counterparty to exist. Chapter 4, The Golden Lifeboat. Let's talk about October 2025, the month the music stopped. You remember the headlines, or maybe you don't. Maybe by October, you were too busy trying to find a grocery store that still had powdered milk to care about the commodities exchange. But on a Tuesday morning, in a quiet trading pit in London, gold breached $4,000 an ounce. $4,000. The news anchors tried to spin it. They called it a bubble. They called it a speculative mania. They brought on economists in expensive suits to tell you that gold pays no yield, that it's a barbaric relic, that you should stay the course in your 60/40 portfolio. They were lying. They weren't buying gold because they wanted a return on investment. They were buying it because they knew the building was on fire. See, $4,000 isn't a price. It's a report card. It is a measurement of the dollar's failure to retain the trust of the very people who print it. When gold hits 4,000, it doesn't mean the metal is worth more. An ounce is still an ounce. It looks the same as it did in Roman times. It weighs the same as it did in the Great Depression. Gold didn't change. The dollar died. And here is the smoking gun. The evidence that proves this wasn't an accident, but an evacuation. 1 month earlier, September 2025. Most people missed it. It was buried in the back pages of the financial reports, hidden beneath the noise of the election cycle and the climate riots. But for the first time in nearly 30 years, for the first time since 1996, global central banks officially held more reserves in gold than in U.S. treasuries. Let that sink in. The Federal Reserve, the European Central Bank, the People's Bank of China, the entities responsible for maintaining the system, they stopped trusting the system. For 50 years, the U.S. Treasury bond was the pristine collateral of the world. It was risk-free. It was the foundation of every pension fund, every insurance policy, every savings account in the Western world. Governments bought American debt because they believed in American power. But in September 2025, they flipped. They looked at the $36 trillion of U.S. debt. They looked at the uninsurable coastlines. They looked at the social unrest. And they quietly, methodically sold the paper and bought the metal. It was a changing of the guard. Look at Poland, a mid-sized European nation, right on the edge of the geopolitical fracture zone. Historically, they held dollars. They held euros. But in 2025, the National Bank of Poland went on a buying spree that shocked the market. They didn't want promises anymore. They wanted bars, heavy, cold, real. Look at China. The People's Bank of China hit 2,303 tons in official reserves. And those are just the official numbers. The real numbers? The numbers hidden in off-balance sheet vehicles and sovereign wealth funds? We can only guess. But they weren't accumulating dollars. They were dumping them. This was the signal. While they told you to buy the dip in the S&P 500, they were selling the top. While they told you that inflation was transitory or under control, they were hedging against a total currency collapse. They built a lifeboat made of gold, and there were no seats for you. Think about the mechanics of this betrayal. It's breathtaking in its cruelty. To buy that much physical gold, tons of it requires suppression. If the price had spiked too early, the panic would have started before they were ready. So they managed the price. They used the paper markets to keep the spot price contained, slowly draining the physical vaults in London and New York, moving the bullion east. By the time the price broke free in October and rocketed to 4,000, the vaults were empty. The transfer of wealth was complete. And now you understand why the line of code from the last chapter matters. Because when the currency resets, when the dollar is finally revalued against this new golden standard, who holds the assets? Not the pension funds. They hold paper, not the 401k accounts. They hold mutual funds filled with unpayable corporate debt. The central banks hold the gold. The elites hold the gold. In the history of financial collapses, there is always a flight to safety, but usually the public is allowed to run alongside the wealthy. In the 1970s, you could buy a Krugerrand. In 2008, you could buy a silver coin, but at $4,000 an ounce, with premiums hitting 50%, with supply chains broken. The average person was priced out of the lifeboat before they even knew the ship was sinking. This is the difference between a recession and a reset. In a recession, you lose your job. In a reset, you lose the value of your labor, past, present, and future. So when you look at that chart, the vertical green line that marks October 2025, don't look at it with greed. Don't wish you had bought perfectly at the bottom. Look at it with fear, because that line is the heartbeat of a dying patient. And the patient is the global economy. The experts will tell you gold is in a bubble. They will tell you it will crash. And maybe in dollar terms, it will fluctuate, but that's the wrong way to look at it. You are measuring the lifeboat by the standards of the sinking ship. The water is rising, the paper is rotting, and the golden boat has already sailed. But here is the darkest part, the part they really don't want you to think about. If the central banks have secured their safety net, if they have successfully swapped their toxic US debt for immutable gold, then they no longer have any incentive to keep the system alive. They have their life vests, which means they are finally ready to let the floodwaters in. You think this is a rescue mission? Look closer. They aren't trying to fix the climate. They aren't trying to patch the hull. They are liquidating the estate. And you are the inventory. When a CEO knows the company is bankrupt, he doesn't announce it on the morning call. He doesn't panic. He quietly sells his shares. He exercises his options. He moves his family trust into protected assets, and all the while, he tells the employees that restructuring is a sign of strength. That is exactly what happened in the third quarter of 2025. While the media was busy distracting you with election cycles and the newest AI hallucinations, the architects of the global financial system were quietly heading for the exits. Let's look at the autopsy. In just 3 months, the third quarter of 2025, central banks purchased a net 220 tons of gold. 220. That is not an investment strategy. That is a raid. They ramped up their purchases by 10% while the price of gold was smashing through records, hitting $3,500 an ounce in April. Think about the psychology of that. Usually, when an asset hits an all-time high, you sell. You take profit. You wait for a dip. But they didn't sell. They bought more. They bought it at the top. They bought it with a frenzy that defies economic logic, unless you understand what they know that you don't. JP Morgan calls it a structural trend, continuing into 2026. I call it a confession. They are trading paper promises. Promises they know they intend to break for the only thing that survives a currency collapse. And here is the beautiful, terrifying irony. The conundrum. Walk into your local commercial bank tomorrow. Ask for investment advice. What will they tell you? They will show you a pie chart. 60% stocks, 40% bonds, a balanced portfolio. They will tell you to trust the resilience of the American consumer. They will tell you to buy the dip. Now, look at what their bosses, the central banks, are doing. Are they buying stocks? No. Are they loading up on 30-year treasury bonds? Absolutely not. They are dumping the dollar. There is a widening chasm between what the system sells to you and what the system buys for itself. The commercial banks are the salesmen. Their job is to keep you in the casino, feeding quarters into the slot machine, convinced that the next pull is the jackpot. The central banks are the house, and the house is cashing out. They have evacuated into hard assets. They have moved their wealth into the physical realm, gold, land, commodities, leaving the digital realm to you. Why? Because digital wealth is permissioned wealth. It exists only as long as the power stays on, and the servers agree that it belongs to you. It is vulnerable to inflation, to hacking, to confiscation, to a line of code that says access denied. Gold is permissionless. It sits in a vault. It does not require a counterparty to honor a contract. It does not require electricity. It simply is. The smart money has already left the building. The record buying we saw in 2024 over 1,000 tons, was the first warning siren. The surge in 2025 was the sound of the lifeboats launching. And if you are still sitting there, staring at your 401k, feeling good about those unrealized gains, you need to wake up. Those gains are a hallucination. They are denominated in a currency that is being abandoned by its own creators. When the Central Bank of China, the Central Bank of Russia, and even the staunch allies in the Middle East begin hoarding metal at record prices, they are sending a signal that is louder than any press conference. They are betting on the end of the current order. They are preparing for a world where the dollar is just a souvenir, a piece of green paper you show your grandchildren to explain why you used to be rich. And the most terrifying part? They need you to stay in the market. They need you to keep buying the debt they are selling. They need you to provide the exit liquidity. Every time you buy an index fund, you are buying the shares they are dumping. Every time you deposit a paycheck, you are buying into the liability they are fleeing. You are the bag holder. The evacuation plan is nearly complete. The doors to the lifeboats are sealing shut. Can you hear that sound? It's not the wind anymore. It's the locking mechanism. They are safe, and we are locked inside. Most people will simply scroll past this warning, content with the official narrative, but you are still listening. You understand the math. The algorithm tries to bury this kind of data, so if you want to find your way back to the truth, you need to subscribe to the channel right now. Don't let the noise drown out the signal.